Let's now bring in our guests very quickly. We're looking at the monetary policy of the central bank and the Nigerian economy. We've been joined right now by Bismarck Rwani. He is the CEO of Financial Derivatives Company Limited. He's here to look at these issues with us. Thank you very much, Bismarck, for coming on the program.
Good morning.
I'm going to start off with this tapering thing because I can see the effects already trickling down before moving to the monetary policy. What's your reaction to this latest development?
Well, tapering was quantitative easing, and the benchmarks or the trigger points for altering the tapering project was basically once unemployment fell below 7%, basically at about 6.5%, and once the U.S. economy started showing signs of recovery, it was time to stop the tapering or start tapering, actually, and stop the easy money policy, keeping interest rates low.
Is it an easy money?
Yes, it is. Tapering is another word for printing money. Okay. And when you print money and money supply increases, interest rates stay low. The whole idea was to keep interest rates low until we got to a point where we could see the recovery has got traction and that unemployment begins to come down. That has happened, and so the market is beginning to react to say, well, what's going to happen next? If interest rates increase in the long end of the curve, the impact of that is that mortgages and some of the consumer loans could go bad. But I think it's been exaggerated. The reality is that the market had overpriced itself. There was a little bit of an asset bubble being created in the U.S. And so there's a mini correction. And that's not going to last too long.
You talked about recovery. How much recovery have we recorded in the U.S. economy? Because we're seeing the impact, not just in the U.S. right now. All the markets now react, and I don't know if Nigeria would take a cue from that anyway. No, but looking at the numbers, they're not all looking good.
No, those markets are indicators, right? Leading indicators, economic indicators. But the fundamental thing is that the U.S. is projecting now to grow at 3% from about 1.8. So that's significant. That's about a 33% increase in the rate of growth. If that happens, when unemployment is down to about 6.5%, we're talking about 8% 2 years ago. That's for a $16 trillion economy. I think that's quite significant. And the U.S. has 3% of the world's population, 25% of the world's output, and 40% of the world's wealth. So whatever happens in the U.S. affects all of us. And of course, it's a reserve currency. Okay,
we'll definitely keep our eyes on this development. Let's not move over now to our own markets. Coming back home, taking a look at the monetary policy decision. Were you actually surprised when the central bank announced the increase on CRR? Many had anticipated the MPR will be retained, but didn't anticipate the increase on the cash reserve requirement.
No, I wasn't surprised. My view was that central banks are proactive, and so the information that we have in the marketplace is always historical. They have information, and let's break down the numbers. Money supply in Nigeria is 15 trillion naira. Of this 15 trillion naira, 3 trillion naira is government deposits. So 20% of total money supply or deposit in the system is government money. If you take the government money and you lend it back to the government, the banks are making a spread for doing nothing. So it was only a question of time before they move it to 75 and move it up to 100, and so that you will take what we call high-powered money out of the system, and the market will price itself at equilibrium. Secondly, there was already a liquidity overhang in the system. We had a long position after the AMCON bonds had been redeemed and all of that. We had a long position about almost 1.5 trillion naira. The effect of this move on the 4th of February is that, first of all, 750 billion naira will leave, and then a little bit more. This would bring the market into some form of near equilibrium. It's not going to jack up rates significantly. It won't happen it won't be a repeat of what happened in July, August. But I figure out that interest rates will go up maybe 1.5 to 2% in the end when it settles. From interest rates coming down to 10 or 11, if you add 10%, if you add 2%, it comes to 12%. Now, is that attractive when you look at the rate of inflation of 8%? Yes, we have a positive real rates of return of 4%. It's also attractive in terms of international funds, hot money coming to the system, so that will actually probably reverse the reverse flows that were taking place already. So all said, the move was not unexpected. The move is forward-looking, but it has serious implications. Right?
Okay, talking about the implications, could this be attributed to having to record worsening high cost of funds in the economy? Because I understand that it's not only the government that banks will lend to.
Yes.
Okay, we have the private sector, and many of these private sector players are actually trying to expand the businesses and contribute to the economy. Now, with NPR at 12% and the CRR raised to 75%, will this not worsen this problem of high cost of funds in the economy?
Now, if you look at the questionnaire sent out to businesses and investors, and access to finance was not the greatest impediment. The greatest impediment was distribution costs, power, and corruption, right? So if you...
Wouldn't this affect the interest rate at the end of the day? Because
it may not, because what has happened is that market rates had actually come down because there was already increased money supply. So what you've done essentially is to take away the excess liquidity. If you look at the average liquidity ratio of the banks, it's much higher than the minimum. It's much higher than the minimum. So it is not to say that you destabilize the banks by doing that. But what you have done is to reduce the money supply excess liquidity so that will actually ensure that the banks, the pricing of their deposits is reflective of the true money supply situation, less government deposits. In any case, the government deposits had actually gone up to, the CRR was already 50%. Many strategic banks had actually discounted the public sector from their business models. That is why the reaction this time after the announcement was not as profound as you had it in July and August. So I think the effects are being exaggerated by the press. The real effect is not going to be more than 1 to 150 basis points.
Interest rates,
yes,
the banks too.
Yeah, the rates at which the interbank market will increase.
Okay.
But that does not mean that it will be passed through to risk asset pricing. Okay, because there's already, there's already the FAC in the system, there's the ANCOM bonds that have been redeemed, and there was already an overhang. So, and what happened was that the central bank had actually reduced money supply. We had negative growth of money supply of 4% in December. So annualized, as against a target of 15% growth in money supply, we had a negative of 4. That means that whatever money supply you increase, right, would neutralize because it was already negative before this announcement in January.